Hello, this is Deborah Pratt Johnson Burns. I am the founder, Chief Prosperity Officer, educator, and mentor at Literacy to Legacy Mentors, Reframing Your Financial Future. It is Connecticut's first ever financial literacy company. Today, we're going to talk about how to become a more informed and more confident investor. What that means is that I'm going to take you through the very basics of investing, and then I'm going to take you through some professional level strategies as well as resources so you understand how to best navigate a very volatile stock market, which is probably the most volatile I've seen in my 35 years of investing. So let's start. First and foremost, what's important to know is what is your investment goal? So depending on your age, depending on your career track and your capital finances, as well as depending on your retirement plans, you will have very different investing goals. So for instance, if you are early investor, let's say in your early 20s, you will most likely be taking the most risk because you have the least to lose, because you have a very wide berth and a very long time horizon till retirement, whenever that may be for you. So secondly, let's say you're in your mid-30s, you have a career established, you're starting a family, for instance, you're going to have very different investment goals and very different investment strategies than someone in their early 20s, because A, you have a family, B, you may have property at this point and you have joint tenancy with your partner and or husband or wife, and your retirement is a little bit closer than it was when you were in your early 20s. Then let's look at when you're in your mid-50s, early 60s, you may be close to retirement, you may be going into retirement, and your investment time horizon as well as risk tolerance is much lower because you're going to need to utilize the capital that you built and the profit and the net proceeds of your investing while you are retired. So let's look a little bit about investment time horizon, which is obviously, as I mentioned, the 20-something, the 30-something, the 50-something, and thereafter. Your risk tolerance is higher when you're younger. So risk tolerance at your 20s is very different than what it is at your 60s. And then also, what are your investment goals? So let's talk a little bit about that. So for instance, in your 20s, you actually may be paying for college, and more power to you. Fantastic. So you're going to be taking out loans that you have a repayment term of 10 years to pay back once you're 6 months after your graduation. And that's terrific. You may also just be starting a career. Secondly, when you're in your 30s, you may be thinking about a family, or you've already started a family and you're buying your first home. So that's a very major commitment. And then in your 50s, you may be midway through your career or almost at the end of your career, and you're deciding, so I've got the house, I've got the college education, I have the career track. Now I really need to be thinking about my retirement. And what does that look like? Typically, the experts say that you should have at least 80% of your net revenue available to you when you retire. So whatever you're making, whether it be $50,000, $100,000, $500,000, think about 80% of that to live on in your retirement. It's a good rule of thumb. So today, as we talk about how to become a more confident and informed investor, please keep in mind those factors of time horizon, risk tolerance, and goals. So the first thing I'd like to share with you is called a watch list. Now, many of you may already have one. I have one that changes on perhaps a quarterly basis because our watch list is driven by market conditions and sector dominance. So for instance, let me show you. This is our watch list. My husband and I are co-investors. So there it is, as you probably can see. Maybe you can't see it terribly clearly, but the good news is the watch list is a list just like that of stocks that you're looking at on a daily basis that you may want to invest in, but actually haven't invested in yet. I'm terribly sorry that's not so clear, but it's on a stock app on your iPhone and or on your Android phone. So you look at the categories and the stocks that you're interested in. So for instance, tech, energy, shipping, consumer goods. There are many, many different categories to invest in. The most important thing to remember is this. When you're investing, you must keep in mind one very, very important thing, and that is, what is inflation? So inflation right now is the cost of goods, and the rate at this point, as of today, is 8%. Now, that's historic. It has not been that high in 40 years. What that means is that goods and services purchased are purchased with a lot more money than they were prior to the inflation rate being so high. Inflation is typically, by the way, between 2 and 3%. So your goods and services are much more expensive, and your dollar has less value. What that means is that when you invest, you must take that into consideration, because ideally, you really want to earn more than inflation. So for instance, you're going to be looking at growth, value, investment dividends, capital gains, et cetera. And specifically, you may want to look at investments that yield beyond 8%. Now you're probably thinking, wow, that's really not easy to do. Correct, it's not. So that's why you need to take your sweet time and do lots of investing and investigating and looking at where are those stocks that are yielding not only that kind of growth in a market like this, which is very volatile, as you know, or what are they yielding in a dividend yield? So two things. One is look at the sector you are interested in investing in. So as I mentioned, are you a growth stock person? So you're more than likely going to be looking at categories in the market that are actually growing exponentially, even in a market like we have today. As an example, Apple and tech are, despite today's growth, are not doing terribly well. In fact, they're down probably 25 to 30%. So that's most unfortunate, but it's also cyclical. So hang in there. Secondly, you may look at categories like oil and gas, energy, pipeline companies, et cetera. So those companies are doing extremely well because of supply and demand. So if you're an interested oil investor, for instance, you look at the categories and say, so what are the strongest stocks in the S&P in this category? And you'll learn, based on the resources I'm about to share with you, that they will be ranked by some of the top investor resources that I use and the professionals use as well. And they include Morningstar, they include Zacks. They have a really phenomenal rating system, and I don't work for any one of those companies, by the way. And also, there are two other sources that you can look at called Seeking Alpha, which is a paid subscription, as well as Tip Ranks. And those four sources can give you a pretty good idea of what sectors are strong and why you would invest in them. So you're going to be reading articles pretty exhaustively from each one of those sources. Of course, there are many other sources you can look at, and they may have contrasting feedback and contrasting insights. But if you stick with the professional level resources, they're pretty consistently rating stocks based on growth, based on dividend income, and year over year, quarterly, et cetera. So you're going to look at those resources and those particular sectors. As an example, right now, obviously, you may have seen, technology is not doing terribly well. But it doesn't mean it's not going to do well. So the number one rule in investing is patience. And I'm sure you've heard the phrase buy and hold. There's a lot to be said for that, because if you have the patience to withstand the storm, so to speak, such as the one we're in right now, you actually will do better than the investor that pops in and out like a day trader or a market trader. There's no such thing as timing the market. And if you think you can, I highly recommend that you don't. And you'll see that you can gain over a couple 100% if you hang on to a particular stock through the ups and the downs of the market. So that's sort of the first thing. The second thing is look at the categories that matter to you. Are you interested in consumables, in consumer goods? What categories ethically, philosophically, are you interested in? And then you need to really determine what are the companies in those sectors that matter to you. So, of course, we know Apple, Microsoft, Google, et cetera, are some of the biggest players, trillion-dollar valuations, et cetera, Apple in particular. And yes, they're really amazing growth stocks, and they've done exponentially well up until this year. And then the dynamic changes as it does, and you still may hold them. But as I said, buy and hold. You may see some dividend increases. You may see some dividends from these particular stocks, but you may or may not see the growth. And the reasons are geopolitical, economic globally, cyclical industry-wise, as well as the stocks themselves. There may be stock buybacks, there may be cuts in dividends, et cetera. So pay attention to all of those factors and then determine, do I want to be in tech right now? Maybe not. Or maybe you're already in tech in a significant way and you don't want to take any capital losses on your tax return. So, and if you're trading in your IRA, then you have no consequences whatsoever until you actually sell the stock. So there's that. Then you look at, so how is that stock doing compared to its peers? So on every single stock trading platform, if you will, so we know there are many, such as Schwab.com, Robinhood, of course, TD Ameritrade. There are many. I'm not a proponent of any particular one. I happen to be with one I am very fond of for many decades now. And the reason being, they're very thorough and they're very consistent. And I like both of those things in my life. So I do use their charts, their graphs. I use everything that they offer to me because it's so very thorough and really helps me to make smart, informed, and confident decisions. So when you look at a stock, for instance, on a platform, you will notice they break the stock down in all sorts of different ways. And at the very bottom of the page of a stock, for instance, again, let's say Apple, you'll see the competitors in that space and how they compare to the competitors, and then how they compared to the S&P in terms of growth and value. So that's something to look at as well. Now back to the resources. If you would like to use some of these professional level resources, I believe in investment spending. Number one, you get what you pay for. Number two, you have to have the best resources to make the most informed and confident decisions. Just reading the Wall Street Journal and The Economist and maybe even the Financial Times is not going to be enough for you to make an informed decision. You have to look at what the experts and traders and investors and people who work for accredited FINRA, CIPRA, wealth management firms are actually saying, in addition to the analysts. There are certified financial analysts who actually analyze stocks all day long, every day. And they're in essence doing the work for you, which is beautiful, because I'm not in a position, nor are many that I know who are self-directed investors as we are, to interpret those charts as expertly as those people do. So I rely on them to do the due diligence, so to speak. And then I, in turn, with my husband, actually look at those charts and take away where we think it makes sense to invest. Now, the next thing to keep in mind is you're looking at those resources and you're determining what you'd like to invest in terms of stocks, whether it be in whatever sector you're interested in. The next thing to consider is allocation. So where are you putting your money and why? So again, it goes back to the goals. So if you have a short-term goal of you have to pay for your daughter's wedding, you have to pay for your 50th wedding anniversary, you want to buy a second home. These are just examples. You would need to determine what your strategy is to make that capital that you have invested work for you and work very hard for you if your time horizon, for instance, is only a year. And not 5 or 10 years. You need the capital now outside of your earning capacity in your career. So we do take dividends and take capital gains when you buy and sell stocks. If it's a taxable account, you will be paying tax on that at your rate, whatever that is. And you have to keep that in mind with respect to your earning capacity. So let's say you're making 50,000 and you sold a stock worth 30,000 and your capital gain is 10,000. Well, you're really making 60,000. So you need to take all of these things into consideration very, very prudently and very conservatively, but also very wisely, because it all adds up and then it bumps you into another category. So for instance, tax-wise, just as an example, irs.gov, you're more than welcome to check it out at any time. They will give you the single filers, married filing jointly. And I happen to know, because I am a married filing jointly candidate, that they actually say this year, if you were to buy and sell this year in the market, the non-capital gains tax, in other words, you won't be taxed up till about 81,000. That's pretty remarkable. Meaning that if anything that you earn, whether it in your career, your investments, your other sources of revenue, you may be a real estate owner and you may be getting revenue from that. All of these revenue sources add up and they put you in a specific bracket. So when you do buy and sell, another thing to be very, very aware of is that where is this going to let me fall in the bracket? So look up the irs.gov brackets. I haven't memorized them, frankly, but I do know that anything over 81,000 and change, you're going to be paying tax, not only on your income, obviously, but more importantly on your investments. And it is ordinary income when you do cash in your investments and you decide to take the cash, which is capital appreciation, and dividends, should you wish to take those as well. So these are very serious considerations, and make sure you make those decisions wisely. Now, in terms of getting into the market and doing the due diligence yourself, I have a system. We've developed our own system to put stocks through. It's extremely rigorous, and a lot of them don't even make the cut. So you have to determine what are your criteria for these particular companies that you're going to be investing in. Are you interested in investing in them because they're going to be tremendously profitable? Awesome. Then go for it. And just my consideration on a daily basis, which I do this on a daily basis, is watch the market as often and as seriously as you would anything else. Because markets in this particular volatile condition, this landscape we're working in, can change very, very rapidly. And that will affect your investments. And I'm not suggesting you let the market dictate what you're investing in per se. These are your philosophical and practical decisions. But do take a look at what the world markets are doing, because oil prices are going to fluctuate dramatically. Growth stocks are going to fluctuate dramatically depending on when you go in and you have supply and demand. What's going in those countries, for instance, for Apple in China. What's going on in China right now? Well, they're on a lockdown because of a very serious variant of COVID, and that's going to affect chip prices. So there are a lot of things to think about, and it might sound exhausting, which it frankly can be unless you absolutely love it like I do. And to me, it's a challenge, and it's fabulous, and it's fun. So, and you hopefully will be wildly profitable. But again, yesterday's benefits and yesterday's results are no guarantee of future results. So do keep that in mind. Well, yeah, look what I did last year. Last year is absolutely no comparison to this year. It's like apples and oranges and night and day. So it's important not to compare, maybe contrast, but not compare. So those are my thoughts for today in terms of what I feel you need to look at in your investment strategies. Again, what is your time horizon? What is your risk tolerance? Make sure you're looking at all the sectors that are growing. They are cyclical, so watch the professional level resources as well as the media. What's going on in the countries where your companies are originating, if they're international, for instance. That will directly and dramatically affect the stock price. And it could go down precipitously without anything that you even knew about before. So that could be sort of shocking. But again, no emotions here. Check your emotions at the door. It is one of the hardest things a self-directed investor has to deal with. And that is, emotional trading, and it's never pretty, and it's never a good idea. So like when you go to the store and you see this pretty thing you want, or even online, take a minute, take a breath, and maybe make that decision later, because any kind of impulsive decision is not terribly good in the long run, and that includes stock investing. So do take a look at those resources. As I mentioned, Seeking Alpha, Tip Ranks, Zacks, those in particular are really fine resources, and you'll have to invest in those because they charge professional level traders a serious chunk of change, hundreds and hundreds, if not thousands of dollars per subscription per year. So keep that in mind. And learn as much as you possibly can about the stock market is also a suggestion. I'm always learning. I'm learning all the time from professionals. I'm taking classes. I'm taking courses. I've been doing this for 35 years. I'm a beginner. I'm learning. I'm always learning because things are really different every decade, every year. Things change so dramatically that what worked last year, as I just said, is not going to work this year at all. So it's important that you invest your hard-earned money very wisely. And on my website, you'll find a glossary of personal finance terms. You will find a glossary of trust and estate terms. You need to look at some of those articles as well on my website. It's all under Resources tab to see what are the experts writing about and why should I care? Because they're actually writing about sectors. They're writing about specific industries as well as specific stocks that are either wildly benefiting from the supply and demand and the interest rate hikes and the inflation. Shockingly enough, that's true. Or they may not be. So it's important to be very, very cognizant of what's going on in the world and to be worldly and insightful. And to take this very seriously. This is not a game. This is not a gaming of the stock market in terms of what happened with Reddit and GameStop, et cetera. This is not gambling. This is very serious business. So take it very seriously. There is no get-rich-quick scheme here. If that's something you want to do, get out of the market and don't come back, because that doesn't exist. And if it does, it's for those very rarefied professionals and frankly, multimillionaires who can actually afford to lose it. And most of us cannot afford to lose our hard-earned income, as well as our hard-earned capital that we made in the market. So take those into consideration as well. And should you have any questions, I provide a complimentary consultation. It is up to 30 minutes with me on Zoom or on the phone to talk about your financial challenges, whatever they may be, investing or otherwise. And you can sign up for this complimentary consultation on www.literacytolegacymentors.net. That's www.literacytolegacymentors.net. Get Started tab. So just click on that and you just have to fill out a cute little form and set up an appointment with me and you're good to go. I also offer a complimentary Financial Freedom Education and Entrepreneur Spotlight series. It's extremely informative, and it's a power half-hour interview that I host every Wednesday evening at 5:30 with experts from the legal, financial, interest, insurance, as well as higher education industries. And we talk about all of the most important topics to investors today, as well as to people dealing with family issues such as estates and wills and transfer of assets, et cetera. So I look forward to seeing you at one of my events. I will be speaking again next week on how to invest in a high inflation, high interest rate market successfully. So do join me. I look forward to seeing you then. And thank you so, so much for your interest, and happy investing and safe investing. Thank you so much. Have a terrific day.